So we've got our 30th edition of the Collar Barometer. When we started 15 years ago, it was the first of its kind. We went out and we asked investors their views of the private equity market. One of the things I wanted to do today was not just to talk about some of the findings from this barometer, but was actually to look back across this 15-year history and pick out some of the elements that have stayed the same and some that have changed. So perhaps we should start with things that have stayed the same over that 15-year period.
One thing that has definitely stayed the same is investors' appetite for the alternatives asset class and private equity in particular. A trend that we've seen since 2010 with on average 1/3 of investors expecting to increase their allocations to private equity. That's further evidenced by the fact that respondents, or 50% of respondents, expect that in 10 years from now, 10% or more of their total investment program will be allocated to private equity.
That's something that actually hasn't changed from barometer to barometer. There's been this constant increase. So having talked about what stayed the same, what's changed?
Returns have changed, John. Returns have trended down. There are fewer investors reporting returns in excess of 16%. However, the vast majority are still recording returns in excess of 11%, which is pretty good in the current market environment.
So is that something that should concern investors, the fact that returns have trended downwards?
I don't think it's a problem, but there's got to be an acceptance of the new paradigm, which is low to mid-teens, which, mind you, still compares very well to sectors like hedge funds and real estate.
So we've seen that sort of maturation and change in returns. And I'd argue, actually, there's also been a reduction in risk across time as that's become more sophisticated. So let's think for a second, rather than the broader private equity industry, what about subsectors within it?
Well, looking at the secondaries industry, the industry that Coller Capital operates in, 15 years ago when the barometer started, the total volumes in the secondary market were about $10 billion per annum. For 2019, we expect that to have increased to 80 to 90 billion per annum. So that's a remarkable increase over a 15-year period.
It's a huge change, and I think to me clearly represents a market that is also maturing. So perhaps thinking about what's happening now, what's new in secondaries?
There's one particularly exciting theme for us, which is the so-called GP-led secondary transactions. It's a type of transaction where the private equity manager provides liquidity, typically on mature assets in funds that are running out of term. It is a strategy that didn't really exist a couple of years ago. It's grown very rapidly at double-digit rates, currently accounting for about 1/3 of the total transaction volume, and we'd expect that proportion to remain there in the future. And what's also very important is that there is a general acceptance to that type of transaction. The barometer reports that 2/3 of the investors report having lived through one of these transactions now. So it's very much becoming a mainstream.
So it all sounds super established. Does anybody have any concerns in this?
There are potential issues that need to be managed appropriately. One that is highlighted by the investors is the potential conflict of interest among the different stakeholders. These processes tend to be time-consuming and quite resource-intensive.
And don't forget there's help at hand. The Institutional Limited Partners Association, ILPA, publishing best practice guidelines earlier in the year in April 2019 to advise investors and managers alike on how to maximize alignment in these type of GP-led situations. I guess it illustrates how ILPA has helped shape the development of the private equity industry over the last decade, something that is recognized by nearly all respondents to the barometer.
I think there's an interesting parallel also in the co-investment story. So that's where an investor is investing directly alongside the manager in the underlying company, but outside of the fund. And that's something when it was first introduced that was new, unusual, strange. There were concerns around it, but now actually seems very normal.
I agree, John. That comparison makes a lot of sense, and we'd expect GP-led secondary transactions very much to follow the trend. And as you're well aware of, the co-investments are so much in demand at the moment. Having said that, again, we need to be mindful of the fact that it is a different skill set that's required to pursue those types of investments successfully.
Yeah, and I think that works across both sides of the fence. We're seeing both managers and investors having to spend more time because the asset class itself has become more complex, more sophisticated and more mature. But I think that trade-off of risks and returns is something that is really relevant to LPs. They continue to want to not just hold private equity, but to increase their allocations. And so finally, perhaps inspired by the 50th anniversary of the moon landings, we asked investors about space tech. And I must admit, when I first read this, I thought it said tech space, which would be more familiar to me. But apparently, 1 in 8 investors say they can see themselves investing in space tech. What's your view?
Clearly a fascinating area of the alternatives asset class, but maybe not as unlikely as it sounds, with UBS expecting the space industry to grow to nearly $1 trillion in value over the next few decades. Some barometer respondents indeed showed interest in investing into the space industry, albeit truth be told, it's still a minority.
Maybe a minority, but perhaps it's one of those things that seems unusual at first, but then becomes very normal and accepted part of the landscape. Maybe it's a question for our 50th barometer.